Breaking out of a range, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, President Trump unleashes fresh attacks on European allies and renews his push to take Greenland.
Meanwhile, earnings could offer an early read on how Trump's proposed policy and geopolitical risks will filter through corporate America.
Plus, Netflix's all-cash offer to buy Warner Brothers raises its debt and ramps up pressure on Paramount Skydance.
So it's starting out to be a pretty ugly morning, the first trading day of this holiday shortened week. It is tech that is leading the sell-off. Let's take a look at some of these big cap tech names: Nvidia, Tesla, Amazon. Again, the news isn't specific to tech companies, but it is concerns. Is it Greenland? Is it Japanese bonds? We're going to catch up with Julian Emanuel from Evercore in a little bit. Interested to see what he thinks. But Matt, across the board, a painful day for the Mag 7.
Yeah, the Japanese bond yields gapped higher. It was amazing to watch. We had some regional bank earnings here in the U.S. this morning. KeyBank's forecast underwhelmed, while U.S. Bancorp's outlook topped estimates, and Fifth Third results came in line with expectations. You can see Bancorp is actually up a little bit. The other two down in what is set to be a down market with futures, Dani. At one point off 1.7% on the S&P.
So we've come back a little bit from that, but all eyes are on the geopolitics. On Davos, as President Trump deepens his feud with the European Union over Greenland. A Danish pension fund now plans to exit U.S. treasuries. Trump doesn't expect much of a challenge to take control of the territory.
I don't think they're going to push back too much. Look, we have to have it. They have to have this done. They can't protect it. NATO's been warning Denmark for about 20 years now, longer than that, 25 years. They've been warning Denmark about the Russian threat. And it's not only Russia, it's also China. So we'll see what happens. But let's put it this way. It's going to be a very interesting Davos.
It already has been an interesting Davos. Joining us now is Evercore ISI Chief Equity Strategist Julian Emanuel. Julian, thank you so much for joining on this morning.
Good morning.
Okay, a lot to get through. But on that Danish pension, we should be clear, it's only $100 million worth of treasuries that they're selling off, which is truly a drop in the bucket. But when you have the head of the pension writing something like this, the U.S. is basically not a good credit, and long-term, the U.S. government finances are not sustainable. Should we be thinking about a Sell America trade re-entering this market?
So if you go back to last year, when the Sell America trade was all the rage, the fact is that this country continues to be the prime destination for capital in varying degrees. Now, look, the global portfolio reallocation after literally a decade of overweight U.S. is something that we think has begun. It's moving very slowly. But frankly, the sell everything, sell America type theory really doesn't tend to hold much water.
You do, though, wake up to headlines like we saw on Saturday with President Trump threatening further tariffs on European allies, thinking, how do I hedge, right? How do I at least protect myself on the downside? With the VIX, holding under 20, the MOVE index just comes down, 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 down. There's no volatility in this market. How do you protect yourself? Where is a safe haven?
Well, it's options on literally every asset class globally have been extraordinarily inexpensive. I mean, we've been scratching our heads for the last 2 weeks, wondering how the VIX could have been 14 and 15 to start the year, how the move, to your point, is at multi-year lows. And essentially, from our point of view, option strategies, puts in a lot of these things make a ton of sense. But the key is hedging, not selling, because the underlying subtext of this market is the same that it's been for 3 years. AI is going to drive equities higher when we get to the end of this year.
All right, Julian, you're going to stick with us. We're happy to have you for the morning with us. Julian Emanuel from Evercore ISI. Let's return right now, though, to Davos, Switzerland, where Bloomberg's Lisa Abramowitz is sitting down with Guggenheim CIO Anne Walsh. Lisa?
Thank you so much, Matt. Yeah, I am here with Anne Walsh, CIO of Guggenheim Partners, at a time where everyone is talking about the United States, the rest of the world, what that looks like. As Dani was mentioning just earlier, there was this Danish pension fund that just announced that they were going to sell all of their treasury holdings, saying, quote, the U.S. is basically not a good credit and long term. The U.S. government finances are not sustainable. How much of that are you hearing here?
Well, Lisa, thanks for having me here today in Davos. It's great to see you again. I'm actually hearing quite a bit of concern from participants here here in Davos. A couple things. One, I tend to disagree with the Danish pension plan. I do actually think that the U.S. is a good credit, and in particular, I think U.S. credit is a good credit, and I think fundamentals remain strong. Having said that, what we saw at Liberation Day in 2025 was a risk-off market reaction that has continued to be part of the backdrop. As we sit here today and geopolitics are writ large, what we are really feeling is more of a sense of risk-off. What we saw at Liberation Day was that even quality assets, the historically risk-averse investors, even those sold off. We're starting to see a little bit of that again. And I think the reason is the sentiment, as expressed by the Danish pension plan, is being felt more broadly. Where do you invest when there's such uncertainty? And so that sentiment is really pervading the markets. It hasn't really settled into the markets because I think there's really a sense that perhaps this will all settle down and the markets will go back to pricing in market referencing information, interest rates, fundamentals, earnings, and the geopolitics will sort of fade into the background.
Is this a new dynamic, though? And we've been talking ad nauseum about the death of the 60-40 and how bonds don't offer the same type of counterbalance to stocks. But it feels like something else is afoot with more populist policies, what's happening in Japan. Are you shifting away from some of the developed market sovereign debt just more generally as a result of some of these trends?
Well, I hate to say it, but the word for the day is diversification. And in all truth, that's been something that's been a theme for us that started in 2025 as we are looking for good places to deploy capital. And that means to be thoughtful with regard to risk management and to be really thoughtful with regard to selection of securities. So this is an active managers universe in which active managers, particularly in fixed income, which is our primary space, this is where there's going to be a tremendous differentiation as we start to see more and more or experience more and more of this kind of uncertainty. And so being thoughtful with regard to risk management and being careful with deployment of capital across any number of different sectors I think is going to be benefiting investors.
If you are worried about risk management and you take a look at the policy uncertainty in the United States, does that make you sort of de facto look elsewhere as part of that diversification?
Well, again, I think that the credit fundamentals are pretty good in the U.S. Right now, we have the One Big Beautiful Bill, which will be benefiting the economy in the first half of 2026. We have, believe it or not, a Fed that's relatively thoughtful and, dare I say, more on the easing side relative to history. And we think there's probably a couple more cuts to come in Fed funds, likely later in the year, but that we're still seeing disinflation, although at a slowing pace. And so as a result, I think the fundamentals, or at least for the first half of 2026 in the U.S., are still supportive of credit and equities, but not without volatility and noise caused by headlines like what we're living through right now.
You know, it just feels like there's a bipolar universe here. On one hand, you've got the political uncertainty, you've got concern, you've got the sense of unease that you've got coming out of the rhetoric that we're hearing from national leaders. And then you have companies coming out, going gangbusters, deals galore, looking at growth everywhere, accelerating around the world. At what point do these two stories start to come together a little bit more?
Well, when you're late cycle, as we are, and as a result, we've seen several years of outstanding returns in the U.S. equities markets. We've seen a rather, I'll call it, benign fixed income market with the 10-year trading in a trading range. And even though we're seeing a little sell-off in the 10-year right now, we're still within that trading range, mid-3s to mid-4s. And so as a result, that's not a bad backdrop for corporate America. But when you get late cycle, nervousness starts to prevail. And when you're seeing and hearing more geopolitical headlines, that just accelerates that nervousness and makes investors more wary of what could be and protective of the gains that they've already received.
How much do you see this year being a repeat of last year? Or do you think that it's going to be peppered with a bit more caution? I remember last year we were here in Davos and people were saying, well, the U.S. is going to be the bright spot. It's got so much going for it. We had a lot more volatility after that. We did, though, see pretty big gains, although outsized elsewhere. Do you see it shaping up to be very similar in 2026?
So in 2025, it was the first year of the Trump administration. And I think the markets and the economy were being impacted by what I would call the Trump administration predominantly domestic policies. The rollout of tax, the bill, immigration, tariffs, which is also touches on international, and deregulation. Here we enter the second year of the Trump administration, and I think we're broadening out to include geopolitics as we start to see the Trump administration move their viewpoint more broadly. And that is unsettling for global trading partners, and it's also unsettled. It creates unsettlement for the global markets. As a result, this sort of realignment, if you will, geopolitically is going to continue in the year. So I think the focus sort of shifts. And so as a result, I don't think it's a replay of 2025. But again, starting out, fundamentals look supportive of a reasonable market year, although with volatility, which we saw in 2025. I mean, Liberation Day came out of the woods for a lot of investors, too. And so I continue to see and expect the unexpected.
Gold has gained some 9% so far this year, just in the first three trading weeks of 2026. It's just been a phenomenal run. Is that the ongoing diversifier of last resort that you can keep on counting on?
As we saw sovereign investors move away from U.S. treasuries, they put their money someplace else. A lot of that in 2025 was in precious metals, in particular gold. That will continue as again, going back to the Danish pension plan, where investors are looking for alternative places to recycle dollars, and they're going to be trying to find stability. And gold has been a tremendous performer and should expect to benefit from this level of uncertainty that's in the marketplace.
How much have you increased your allocation to gold?
We didn't increase it. We put it on in 2024, and we've kept our position for the holding, and we've obviously seen the benefits of that. Silver.
What's your biggest contrarian bet heading into the remainder of 2026?
Wow, that's a good question with regard to contrarian bets. One of the challenges that I have as an investor is risk mitigation, and so I think there's a lot that could happen in the back half of 2027, and tail risk is high. So I can't say I have a contrarian positive bet, although we're going to keep our silver trade on. But at the same time, I'm just going to protect the portfolios against adversity.
Are you more worried about that adversity coming in the form of some sort of economic slowdown or some sort of inflationary surge? So
the tailwinds that we've got right now are so strong for the first half of 2026. There's a risk that those evaporate in the second half. But having said that, this is an election year in the U.S. for midterms, and politicians do happen to like to be reelected. And so their interest in keeping some sort of stimulus behavior going is going to be strong and pervasive. And so I anticipate that we probably will see an extension of those tailwinds into the second half. But having said that as well, I would be wary, again, tail risks. Our expectation is that we don't see a recession. It's not in our outlook. It's not in our base case. And a lot would have to happen to see that. But a market sentiment-driven sell-off is quite possible, in which case, historically, since the financial crisis, those big sell-offs don't last long, and the reacceleration, or if you will, the buy-the-dip mentality, emerges very rapidly.
So waiting for the dip to buy, that seems to be the trend. Anne Walsh, thank you so much for being with us today. Anne Walsh of Guggenheim Partners. And I'm going to send it back to you, Dani and Matt, in New York.
All right, Lisa, thanks very much. Lisa Abramowitz there, and we thank Anne Walsh of Guggenheim for her time. Let's bring back in Evercore ISI Chief Equity Strategist Julian Emanuel. Julian just came out with a list of market surprises, potential market surprises for 2026. And what I love about this list, Julian, is that not only do you highlight what could surprise, but also how to play it. And, of course, we protect the copyright of our guests, so go ahead and look at Evercore ISI website for that. But or subscribe to Julian's research. What would you say has changed over this weekend? I mean, if you were going to write this list again this morning, would it be different than on Friday?
Well, we would have probably bumped up the potential for the U.S. taking control of Greenland from number 7 a little higher in the pecking order, although the prediction markets are only incrementally assigning a higher probability. And, of course, our trade there is to own Euro Stoxx 600 puts, which certainly have done their share of the heavy lifting these last 2 sessions. And then the other one, I think, and this complicates what's going on in Greenland a bit more, is our view that there's a potential for the U.S. 10-year yield to trade above 5% in 2026. Now, 2 things. Obviously, the surge in yields in Japan is difficult for our markets to digest. It plays into this more cautionary narrative around asset volatility with regard to Greenland. But again, it just points out the fact, as it was last year, that part of the underlying strength of the U.S. market is our ability to keep interest rates in check.
So does that mean that the sell-off that we've seen in Japan, how are you weighing it in terms of what has been the driver of the market for today and what that means for the driver of a market going forward? On a down day like this, is it more important to have the geopolitical concerns that maybe Europe is going to be hit with more tariffs, or to have Japanese bond yields hit the highest on record?
Well, on a down day like this, you would prefer to see fixed income acting as a shock absorber, right, not a shock accelerator. But obviously, again, Japan changed that narrative. It's going to be, in our mind, if we get to that 4.5% level, where, if you think about what happened last year, that was the type of level where the Trump administration started rethinking its approach to tariffs. Do you get that kind of rethink with regard to what's going on in Greenland? You know, today, Trump appears to still be in sort of acceleration mode on the subject, but things are moving very quickly.
I want to focus in on the U.S. debt market, because Anne Walsh said this fundamentals are strong, and it's almost like a throwaway comment that a Treasury Secretary would make about dollar strength. I mean, are they really strong? Are they stronger than they were a month ago or a year ago, as we have debt to GDP ratios of 100% plus, 6 to 7% deficit spending outside of a recession, and that with 4 to 5% interest rates? I mean, it doesn't seem that strong.
And the sum total of what you've just said from time to time has certainly been something that's roiled markets. And again, and I go back to the establishment of the Peterson Institute, I think 40 years ago, to deal with the concept of the debt problem. And here we are 40 years later. It's a much larger problem, but again, it's going to not be a problem until it is, from our point of view, creating incrementally more geopolitical instability creates a greater chance that will be a problem, but we do not see that as a discrete problem in the medium term.
Is it an issue, though, that we came into this year with a lot of bullishness, a lot of confidence, whether it came to overall markets, animal spirits, deals are back on? We were talking about this in the break, that Bank of America's latest fund manager survey shows the lowest amount of hedges since 2018 for equities. Cash levels are at record lows. You were talking about this idea, you don't sell, you want to own options, but it's an issue that people aren't doing that they don't seem to be protecting themselves to the downside.
So our surveys team will poll clients, and the first week of the year, the question was, where's the next 10% in the S&P 500? 75% of the respondents said higher. When we've seen that kind of one-sided viewpoint over the course of last year, we've had pullbacks. So in that sense, it's absolutely not a surprise. And again, for us, it's just a question of, particularly at these valuations, because in the fourth year of a bull market, at these elevated valuations, let's call it imperfect news, which we're facing this morning, is going to cause more volatility.
Let's talk about AI for a moment, because you highlight that. Obviously, that's been the driver of these equity markets for a few years now. Is there a risk that the massive funding needs are difficult to meet, especially for a company like OpenAI, which wants to spend over $1 trillion and only has, I don't know, 20 billion in revenue? How do you square that circle?
So we look at the universe in general, and the spending, for the most part, from the hyperscalers is very, very sustainable as regards to the free cash flow. Obviously, at the private level, those numbers are a little murkier, but the deal pipeline continues to suggest that it is not an issue. And I think essentially what it comes down to is how do markets digest news? And I think to the point, earnings season share price reactions, particularly from the hyperscalers, are going to be very, very important. And from our point of view, the mood has soured in technology and AI over the last 6 weeks, enough such that the bar is set actually lower for tech companies than it is for the rest of the market.
But is this debt issue a lot like the Treasury debt issue, where it doesn't matter until it does? Is it that binary when all of a sudden someone says, oh, this matters? Can we see a total lack of confidence?
Well, look, something like that is possible. But again, go back to December, the company that has clearly taken on, very large levels of debt to finance its plans, it was idiosyncratic. That company's credit default swaps surged higher, but the rest of the credit space and the hyperscalers were largely unaffected. And when you look at the NASDAQ 100, the net result, as we've seen on several occasions during this bull market, is just a sideways churn. And we think that's where we are. Ultimately, we do think all of that's going to resolve higher.
But this gets back to something you put in your list of surprises. And I love how you started this saying, have we as investors lost the capacity to be surprised? It does kind of feel like that, Julian, that you get these momentary bouts of concern about momentary bouts about geopolitics or tariffs, but we end up buying the dip and we end up higher. Have we lost the capacity to be surprised? Do we just now have this Pavlovian urge to buy the dip and nothing matters?
Well, that's why this morning is such a stark reminder, okay? The over-enthusiasm was exactly that, over-enthusiasm. But when you think about the fundamentals of a year where earnings are likely to grow at least high single digits, if not low double digits, where you're going to have lots of stimulus in front of midterm elections, and you're going to have an economy, we just raised our GDP forecast to 2.5%, and even then, the risks potentially tilt to the upside. All of that suggests that things are going to continue moving to the upper right, but this is just a reminder that it doesn't happen in a straight line.
But do you worry that it's a fragile house of cards? I mean, as long as everyone's on board, right, there's no bears. As long as everyone from Anne Walsh to Ed Hyman says it's okay until it's not, like, we're going to buy the dip.
And again, days like today don't concern us discreetly. This is a logical reaction to, an unprecedented change in geopolitical configuration. Prospectively, it would be more concerning if the market just laughed this off. Then you would get to, ultimate FOMO, really over-enthusiasm.
Still not a lot of change, Julian. You have the President of the United States essentially threatening military action against NATO to annex a territory, and yields don't move. I mean, more than 5 basis points.
Well, but again, you also have to remember that the interest rate markets has been very, very calm.
Yeah.
There too again, and obviously creeping up in the last week or two, there too again, you're likely to have further upside. Probably episodically, we need to see the next round of data accompanying whatever the ructions are coming from Japan, coming from Davos.
This feels like an awkward question to ask on a very down day when things like small caps are down especially hard. But if this is a year that's going to be led by earnings, that's going to be led by stimulus, is it also a year where leadership broadens out?
So you've seen that these first couple weeks. And our problem with where the market is right now is we believe this can be an everything works year. But if you do the math, everything still needs to be led by technology, AI, et cetera, whether it's the weight of the top 10 at 40% of the index or the weight of the hyperscaler slanted sectors at 55%. But again, like we saw at the end of the internet bull market the last year or so, you had an everything rise. The problem is now is that the first reaction in areas like small caps and cyclicals, where we've seen a lot of buying these first several weeks, is that this narrative of what's going on geopolitically is a bigger threat to the growth trajectory and the pricing in of greater growth than it is in terms of a technological headwind.
By the way, I just want to bring it back quickly to WSL Predict. This is the function on the Bloomberg that I've been looking at so much recently. Rick Rieder's chances of becoming the Fed chair now in the betting markets up to 20% over the weekend from like 5%. Does it matter? Does the Fed matter that much to your outlook for this year, or would it be fine if it just stayed on hold?
A fellow Emory Business School graduate? Great for Rick. Look, this is just another one of these things where the saga is ongoing. We're going to get a name at some point. And, I think the market would be reasonably comfortable with whoever's going to end up crossing the finish line.
Julian, great to spend some time with you this morning. Really appreciate you joining us. Julian Emanuel there from Evercore ISI. Less than 4 minutes until the opening bell as futures are lower. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are sharply lower. S&P futures off 1.5%. NASDAQ futures falling a little bit more. Russell 2000 futures off almost 2% this morning on concern about both the comments President Trump has made in regards to Greenland and what he would do to European allies if they don't essentially give it to us, as well as the huge spike that we saw in Japanese yields on concerns about the tax plan and elections being called there. A foundation ringing the bell at the New York Stock Exchange. Of course, yesterday was Martin Luther King's birthday. Martin Luther King would have been 97 this year's birthday on January 15th. It's, to me, shocking that he still would be so young, but he was taken from us at less than 40. He was only 39 years old when he was assassinated in 1968. Down at the NASDAQ market site, you've got Oxford Lane Capital ringing the opening bell there, and not much to say about them compared to Martin Luther King Jr.,
correct.
right?
Anything pales in comparison.
There's no day, there's no holiday for Oxford Lane Capital.
No, and I think
Maybe
that's
someday.
probably rightly so, at least for now. Matt, I'm looking at the sell-off because it is a big market sell-off this morning. Painful, especially if you consider, as we were talking about with Julian, that this market is not hedged. Bank of America's latest survey showed the least amount of equity correlation hedges since 2018. Nvidia, Tesla, Amazon, all of the Mag 7 down hard, down about 2.9 for Tesla, but at least more than 2.5% across the board, Matt.
Yeah, we had some regional bank earnings this morning. Key banks forecasts underwhelmed, as we've been telling you. U.S. Bancorp's outlook topped estimates, and it was up in the pre-market, down in the cash trade. Fifth Third came in line with expectations. And those shares, although very little changed, bouncing back and forth between gains and losses. Let's get back to Davos, Switzerland, where UK Chancellor Rachel Reeves is at the Bloomberg House with Francine Lacroix. Francine?
Because at the moment there's, wild speculation about whether everything needs negotiating, whether, President Trump goes really hard. I mean, how do you model this?
I would just urge people to keep cool heads.
Cool. Okay.
I mean, that's what we did all through last year, and it actually served us pretty well. And whilst trade barriers are going up around the world at the moment, we can all see that. In the last year, barriers to trade with the UK have fallen. We've secured a comprehensive trade deal with India, which will come into force in the next few months. Just taking legislation through both of our parliaments to secure that. That includes trade in services, support for exports, and also around government procurement. That's a huge deal. The deal with Korea, one of the fastest growing economies as well in the G20, is very important for the UK. But most important probably is the trade with our nearest neighbours and trading partners in the EU, which was damaged after leaving the EU, voting to leave the EU in 2016. We are now fixing that mess by improving trade relations and cooperation with our closest allies and neighbours.
And I want to get back to the EU in a second. Governor Bailey, though, said that he worries about also President Trump's attacks on the Fed, and that could create shockwaves for the UK. Do you agree with that?
I think that people recognise that certainly with this government and with me as Chancellor, there's huge respect for independent economic institutions, whether that is the Bank of England or the Office of Budget Responsibility. One of the reasons why the UK has been, has had challenging economic times the last few years is because the previous Conservative government, particularly under Liz Truss, both played fast and loose with the public finances, but also undermined the economic institutions that make Britain, and have made Britain, a safe and secure place to invest. We're undoing that damage, working closely with the independent economic institutions, but respecting their independence. And that collaboration and fiscal policy supporting monetary policy has enabled those 6 cuts in interest rates, taking rates down to 3.75%. It's the fastest speed of rate reduction in the UK in 17 years, and that's only possible because of the stability that we've returned to the economy and the decisions we've made on fiscal consolidation. And the IMF say that amongst developed economies, we have got the fastest pace of fiscal consolidation over the next few years. And that gives investors confidence around the stability in the UK, our grip on the public finances and our grip on inflation.
So there's no worry about central bank independence that could also impact or inspire maybe some of the opposition in the UK were they to come to power?
Well, look, we won a massive majority just a year and a half ago. We have 3.5 years remaining of in our term in office, and I'm confident that our economic plan to grow the economy with the stability return to the economy, bringing investment in, global investment, as well as unlocking domestic investment, is the right plan. And in the next few months, as inflation returns to target, with lower interest rates, which are benefiting both households and businesses, that we will see the fruits of that in growth and higher living standards.
Chancellor, I don't know whether you're meeting with Scott Bessent, the Treasury Secretary, here, or if you bump into him on promenade.
Well, I was with Scott last week in Washington. I'm seeing Secretary Lutnick later today. Our Prime Minister spoke to President Trump just over the weekend. You know, as you would expect, there are very close relations between our country at all levels.
So here in Davos, you also have an announcement, which is basically helping out with visas. Tell us a little bit about that, and do you worry that it's going to be drowned in everything else that's going on? Just a little bit of news that we have out there.
So I believe in free and fair trade. I believe in the benefits to businesses and also consumers of open economies. Economies that are open to trade, open to investment and open to talent have always been the most successful economies. And I want Britain, even in a world where others are putting up barriers to trade and investment and talent, for Britain to be breaking down those barriers. And we are announcing today further changes in our global talent routes into the UK for 3 particular types of visa. The first is for foreign businesses looking to expand their footprint in the UK, working with them so that they can bring in talent as they expand their footprint. Second, for UK businesses in our industrial strategy sectors, which includes financial services, business services, creative industries, clean energy, advanced manufacturing, defence, etc. For those businesses, if they are bringing in talent from overseas into the UK, their visas will be the fees for those visas will be waived. And then the third announcement today is that for really great talent looking to come to UK universities, again, we'll waive those visas, as well as a specific scheme for people, gold medalists in the Maths Olympiad, offering a number of scholarships to UK universities for those people, because we want Britain to be a magnet for global talent in the same way we want it to be the best place in the world to trade from and to invest in.
Chancellor, there's a growing clamour in labour circles, even from some of your own cabinet, for the UK to join a customs union with the EU. Is that on the cards?
No, it was very clear in our manifesto that we wouldn't be rejoining the single market, the customs union, or bringing back free movement of labour. But what we have done already is brought back the Erasmus scheme, which enables young people both from the UK to go and study at European universities, and young people from Europe to come and study at our brilliant universities in the UK. We also have agreements in principle from last May around the UK doing a food and farming deal to reduce barriers to trade at the border, around electricity trading and energy trading, as well as some form of youth mobility within the European Union and the United Kingdom. So we're making progress in all of that, looking to have another summit this year where we can mark ourselves on progress against those ambitions and set new ambitions, because that summit last year was just the start of improving relations between the UK and the EU. And I would just say that, you know, at these sort of times when others are putting up barriers to trade, what Britain is arguing for, and what I believe in strongly, is that those of us who believe in free and fair trade should practice what we preach and reduce barriers between ourselves. That goes to the UK, the EU, Canada, and other allies around the world. And we are determined to lead from the front in that. We've already secured trade deals with countries around the world. We want to do more in the months to come.
But Chancellor, I mean, mathematically, just, you know, if you leave politics to one side, again, rejoining the customs union could be more beneficial. So do you see a future at any point where the UK goes back in?
We can't go back in time. And since we left the EU, we have done trade deals with India, with the US, with Korea. And obviously, you would lose some of the benefits of those trade deals if you were to re-enter a customs union. Things like the benefits of the deal we did with the US for our automotive sector. The deal that we have with India is better than the deal that any other country has with India. So I think that you have to consider all of these things in the round. I don't think we need to return to the customs union to seize greater benefits of free and fair trade. And we are working piece by piece, but with a strategic goal in mind, which is to make it easier for British businesses to sell into European markets and for European businesses to sell into British markets. And when the barriers to trade in other markets are going up, we want to create more opportunities for our businesses to trade with other countries around the world.
There is, of course, big news about a new embassy, a Chinese embassy.
That was UK Chancellor Rachel Reeves speaking at Bloomberg House in Davos. You can continue to watch the conversation at LiveGo on your terminal. Yeah. Coming up on this show, Netflix makes another move in the fight for Warner Brothers. More on the streaming giant and their now cash deal. Coming up next, you're watching Bloomberg. Let's get you your top calls this morning. What the sell side is upgrading and downgrading. First up, Morgan Stanley, they upgrade Brinker to a buy. They note that the parent of Chili's is well positioned as restaurant expectations reset across the sector. They also see stronger growth in fast casual and beverage concepts, where demand appears more durable. Those shares up 1.6%. Next up, JP Morgan, they downgrade ConocoPhillips, saying that the stock looks fairly valued after resetting its oil sector view for the year. They also prefer U.S. oil majors over Canadian peers as geopolitical risks rise and downstream businesses look more resilient. Finally, Bank of America, they downgrade Ciena, saying that the stock looks expensive and demand signals are starting to top out. They also note that the communications equipment maker may not get many new orders as hyperscalers reduce their capex, and that leads them to a more cautious outlook. Matt, those shares down 1.4%. All
right, so look at the upgrades and downgrades that we've got. Now, let's go to deal news. Netflix making the latest move in the fight for Warner Brothers. It is now offering, as essentially had been expected, all cash for Warner's studio and streaming business. The offer comes as Netflix gets set to report earnings this afternoon, which makes it all the more interesting. Joining us now with the latest is Bloomberg Tech and Media co-host Caroline Hyde. It's all one industry. Caroline, so
throw a few other industries into that. AI is everything,
telecoms,
right?
and cars as well. So Netflix, does this change to all cash make it really that much better than it was and that Paramount Skydance's offer is?
The market seems to be interpreting that it's got a fairer chance, certainly in expediting the deal, certainly getting it over the hill of pushing back on Paramount, which had, again, time and time again, been saying, look, our deal is more appetizing because it is cash, because Warner Brothers Discovery isn't giving us the clarity on what money they'll be getting for the cable networks, which aren't part of the Netflix offer. This gives more certainty on real money they'll be getting because Netflix's share price has been under pressure. Look, it rallies a bit today. They're now worth about $400 billion. At one point, they were worth almost $600 billion. They've come down some 20% since they first announced clinching the deal with Warner Brothers Discovery to a certain extent. So, yeah, if you didn't want $4.50 of shares, you wanted all it in cash, and that looks a little bit better. What's even better for Netflix is that this doesn't affect their leverage much. It'll up it by about 0.5x, is what credit analysts over at Bloomberg Intelligence are saying. They're still really strong fundamentally. And Geetha's team over at Bloomberg Intelligence are just saying this gets them closer to the post. And more broadly, we're likely to have to see Paramount come back. And if anyone's going to take it seriously, they're going to have to up to $32 a share. So we might see maybe some shareholders could be swayed if they get that sort of an amount being offered.
I guess there's this sense, and to your point of the share selling off, if shareholders don't like this deal, they don't want this deal, maybe they don't think Netflix needs it, they're going to have earnings today. Do you think that there will be a sense, maybe not urgency, but a sense from executives that they need to, or at least very much so desire to, expand their IP catalog?
Because they have had hit after hit, and that's going to likely solidify what is this quarter's earnings, where you're seeing almost 20% revenue growth, call about 18%, and that's because you've had the finale of Stranger Things. You've had people being interested, actually, in the sports side of the equation. Look, you've had Anthony Joshua versus the Paul brother, whichever one you want to pick, but that big fight, everyone wanted in on that. NFL over the Christmas. Maybe they do have to start to get into the live broadcast side of the equation if they're going to get more and more of us signing up. The revenues growth is still strong. US, Europe, Asia, APAC, and Latin America. But are they going to be able to continue getting us to switch across from cable and decide that we're all in on Netflix? To do that, maybe they have to up their sports catalog, but they have to up their catalog more broadly, and Warner Brothers Discovery would really help them do that. What they have, like 450 million people subscribing to the joint of the combined powerhouse that it would be. They do need to show that they're going to get almost double-digit growth revenue this quarter, this year. But what about next year? And people will really want to see, look, you are going to be bringing in $50 billion in terms of revenue for the next fiscal year. And that's about 13% growth. It is slightly slower than this quarter and this year just gone.
All right, Caroline, we look forward to your program. Bloomberg Tech kicks off at 11. Caroline Hyde there with Ed Ludlow. We'll take you through that hour. And, of course, there'll be a lot of focus on Netflix, this deal for Warner Brothers, and I hope a little bit of K-pop demon hunters as well. Coming up, President Trump threatens legal action against J.P. Morgan. We look at the battle between Washington and Wall Street next. This is Bloomberg Open Interest.
The question is, what you don't want to do is, squeeze out or drain credit from exactly that section of the population that needs it most. So, once again, this will land somewhere, and there'll be an element of adjustment and compromise. We are in constant communication with various policymakers and the like, and the industry too, because it's not just Citi, it is the old street that is, And once again, I think affordability thing is something that has to be dealt with, and we will land somewhere.
That was Citi's global banking head speaking to Bloomberg in Davos House. His comments come as the White House weighs an executive action to enact a cap on credit card interest rates. For more, Herman Chan, senior U.S. bank analyst for Bloomberg Intelligence, joins us. Herman, not only are they weighing it, today was supposed to be this deadline.
It is this deadline, right?
Okay, well, yeah, but is it a legal deadline? That's a little bit more squishy, but it's the Trump-imposed deadline. Have we had any movement at all from banks for them to offer a credit card that caps rates at 10%?
It is a Trump-imposed deadline. We're not sure if that's really a legal deadline, but at this point, it's just status quo for the banks. They're operating like in normal conditions where credit cards are their credit cards. They're not offering a 10% blanket rate, and they're just operating as is.
They are being sued, though, some of them, JP Morgan. Mm-hmm. So what do we know about this lawsuit?
Right. I characterize that as heavy as the head that wears the crown, right? JP Morgan's the biggest bank in the United States, most profitable, really strong returns, really strong valuation. And a lot of that really reflects reputation risk during the prior Biden administration, where it was really embedded into the supervisory actions of bank regulators. So banks had to be a bit more cautious with what happened after the Capitol riots. So I think that's just reflective of how banks had to operate back then. And really now we're seeing the repercussions of that under Trump.
It's also interesting for a sector that is supposed to be benefiting from this White House and from deregulation. On that note, you had some of the regional bank earnings today, and it struck me that 2 of the 3 that reported are undergoing their own M&A.
Right.
Fifth Third with Comerica, and then you also have U.S. Bank Corp with BTIG. Is this just easily the theme? Does that kind of overshadow their individual reports, the fact that the regional banks are becoming more like super regional banks?
Yes, so that's happening, and that's actually one of the positives under the Trump administration, where there's much less red tape for M&A, and that's really struck a chord for the large regionals where they're doing more bank M&A deals. We'd expect that to continue, especially with some of these better valued banks. We're potentially seeing some more activity by the likes of PNC and M&T, and some of these deals that have been announced, they'll be digested and really strengthen the earnings power of U.S. banking.
How much does that M&A continue, Herman? Because I remember when we were talking to you every day about SVB, a lot of people were shocked to hear that there were like 5,000 banks in the U.S. It's an incredibly fragmented market once you get past the top 6 or the top 60. Do you expect that number to shrink?
Yeah.
Are we going to see 4,000? Are we going to see 3,000?
We're a little over 4,000 now. We'll see that shrink over time, and that's just ongoing to continue because there's not a lot of new banks that are opening up. There's not a lot of de novo action, but there is going to be more consolidation because banking industry is super fragmented, and there's a need for economies of scale given the fact that banks are investing in compliance, technology, et cetera. So
and less regulation, right? So I'm just wondering, does this administration supercharge that natural process?
Yeah, it's happening now. So bank deals are getting approved by less than 100 days now. So, and that was something that was unheard of under the Biden administration, where it took upwards of a year or above to do deals. So you're seeing more M&A activity, and that'll continue throughout this term.
All right, Herman, thanks very much. Herman Chan there of Bloomberg Intelligence covers all the banks for us. Go to BIGO on your Bloomberg terminal to find his research. We are almost, 25 minutes into the session here, and you do see losses on the S&P, NASDAQ, and Russell of more than 1%, about 1.33% for the 2 major indexes there, as investors worry a little bit more about geopolitical tensions.
And what's happening in Japan. Yields are easing off after the finance minister told Bloomberg TV, told Haselinda Ammon that he wants markets to be more calm. Scott Bessent also saying that he met with his Japanese counterpart, so clearly it is something that they are worried about.
Coming up,
take a breath, and we will take a breath and come back with more market action. And Nancy Tengler, that's coming up.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. This morning's sell-off now means that the NASDAQ is now with losses for the totality of 2026. The S&P is on its way there, too, with concerns from Greenland to the Japanese bond market.
Coming up, President Trump unleashes fresh attacks on European allies and renews his push to get Greenland.
Meanwhile, earnings could offer an early read on how Trump's proposed policies and geopolitical risks will filter through corporate America.
Plus, Netflix changes its offer to all cash to buy Warner Brothers, raises its debt, and ramps up pressure on Paramount.
We begin with that pressure on Wall Street following President Trump's latest tariff threats. Guggenheim CIO Anne Walsh spoke with Bloomberg in Davos.
What we are really feeling is more of a sense of risk off. What we saw at Liberation Day was that even quality assets, the historically risk-averse investors, even those sold off. We're starting to see a little bit of that again. Where do you invest when there's such uncertainty? And so that sentiment is really pervading the markets. It hasn't really settled into the markets because I think there's really a sense that perhaps this will all settle down.
Joining us now is Nancy Tengler, Laffer Tengler, CEO and CIO. And Nancy, I guess what we saw unravel over this weekend just makes you wonder if there's anything that will make investors, equity or debt, significantly flinch, because you've got now the United States turning on its NATO allies in a pretty serious way, but markets, 1% is the drop in equities and, bond yields rose 5 basis points. Markets don't seem to care.
And they usually don't in these turning point periods, Matt. And it unsettles people. When Iraq invaded Kuwait, the market sold off. But when we went over for Desert Storm, it rallied and it didn't look back on the day of the first drop of a bomb. So the market is dispassionate about geopolitical issues for the most part. I think what the market also understands, we've had a lot of time with President Trump. We had Trump 1.0 and now this. And I think Anne Marie nailed it this morning on surveillance when she said, he starts at an extreme and then he comes to the middle. And that's what we're seeing. We're not going to invade Greenland. And so I think what he's doing is he's ruffling feathers to get people to come to his negotiating position. I'm not saying this is the right way to run a country or the world, in fact, but this is what we've seen from him historically. And so what markets, I think, are focused on are the things you and I are focused on: earnings, productivity improvements. And we're hearing a lot of productivity improvements from AI already in this earnings season, starting with the financials.
What about, as a concentration of this equity market, the Japanese bond market, Nancy? Could that be more behind the moves we're seeing today? And does that indicate, if there continues to be pressure there, that it could be a bad thing, not just for U.S. Treasuries, but for U.S. equities as well?
Eventually, I think that's right, Dani. I think if you see this push through the markets and sustain, much like we had the carry trade not so very long ago that really did some damage in the short term, but not in the long term. I think that U.S. equities are probably going to remain resilient simply because they are supported by earnings. Economic growth in the U.S. is very strong, and we can have robust stock returns coexist with higher bond yields like we did in the 1990s. So that can happen. We did, of course, have a Fed then and a chairman in Greenspan that understood productivity and was able to let the economy run a little hot because he knew that productivity growth would bring down inflation. So I think there's a lot on the positive side. There's always the wall of worry we're climbing, and I do think Japan has some unique issues they need to work through.
You got to do a lot of math and mental gymnastics in your job, Nancy, but if we have higher bond yields, and Julian Emanuel listed as one of his surprises out of Evercore ISI for the year, we could see, or if we did, it would be a surprise, 5% on the 10-year. Wouldn't that be a real concern because it carries through to the 6 to 7% budget deficit that we're running and the 125% debt to GDP that we have in this country? All of a sudden, there's a cascade of issues that you have to worry about as an equity investor.
Yes, I think that is the real risk because in the 90s, we didn't have the debt to equity ratio or debt to GDP ratio we have currently. So I think those are all important and things that you have to be careful thinking about. But that said, we've got a Treasury Secretary who's pretty adept at playing the game. He's been issuing at the short end. I'm not saying this is a sustainable or good strategy, but I think that there's a lot of levers to pull at Treasury, and I think he understands that. So we'll see. I mean, a 5% yield on the 10-year, we had it again in the 90s, and we saw, the Fed raise rate once after cutting in the 90s. But again, the geopolitical and then the U.S. deficit issues were very different back then. Bessent was talking this morning about how, the deficit has come down, debt to GDP. I don't know that we can say that yet.
In the 90s, we had a budget surplus, and we had a government and an executive that were focused on free market capitalism, which is very different than what we're looking at right now.
Yeah, it's a good point. I mean, Nancy, every day it's a headline of something impacting equities. I mean, today it is the self-imposed deadline, not self-imposed, the Trump-imposed deadline for banks to have credit cards capped at 10% interest rates. He was also talking about over the weekend about suing JP Morgan for what he claims is debanking him. How are you thinking about each of these things that comes from the president when it comes to individual companies? You kind of go through the equities you own and say, okay, Trump, I guess, doesn't like Jamie Dimon. Maybe I rethink that bank. Or do you put it to the side as just noise and get back to some of the fundamentals?
It is noise. I hate it, Dani, because I think it sets a terrible precedent. This is not a country that's run off of state capitalism historically. I hated the Nvidia deal, the AMD deal. I hated the equity stake that the government took in Intel because the money was lent on a very different premise. They diluted shareholders. Yes, the price has gone up, but I don't like any of it. And I think that's a policy issue. But in terms of investing, I think this creates opportunities. During the tariff tantrum, we were able to pick off some of these very high quality tech names, which I think will continue to do well, even with higher interest rates. Remember, fortress balance sheets collect more interest income when interest rates go up. And that's what we saw with Microsoft and all of the above during the 2022 rate hikes. We did get a bear market for sure, but it was short-lived. So I think there's a lot to focus on if you look at the fundamentals and you try to tune out these ridiculous declarations that we're getting by the minute.
You make an important point, Nancy. It doesn't really matter how you feel about the policy as an investor. You need to do what's best for your clients, right? So how does an investor, I mean, especially if you suffer from acute TDS, how do you deal with this kind of market?
We've told our clients for decades not to invest their politics. I've had clients sell their equities when President Obama was elected. Another one sold them when President Trump was elected. It never works out very well. So you hold your nose. I turn on gratuitous violence when I get home just because the news is just too much for me all day long. But you do pay attention to the fundamentals. And during the tariff tantrum, we were able to buy Palantir at 88 or add to our holdings. Nvidia at 108. Those look like good trades now, even with recent weakness. Tesla at 240. So you have to make those very difficult decisions in periods of volatility. And if nothing else, the Trump administration creates volatility, and that's an opportunity for long-term investors.
Yeah, and it really feels like only today we're finally getting to some of that volatility. Hey, Nancy, such a pleasure to have you on. Thank you for joining us. And what's been a year so far? Nancy Tengler of Laffer Tengler. I just want to bring us some crossing lines coming across the terminal now. The Supreme Court has not ruled on Trump's tariffs today. Today was a potential ruling day. We did not get it. It's the third day we've done this of looking for a ruling. Will it be delayed into the summer? More rulings to come, I believe, later in the week. So we'll see whether we get any of that. In the meantime, here's what your equity market is doing. Still selling off, not as bad as it was, but we're still down 1.5% for both the S&P and the NASDAQ. As bond yields creep higher, the 10-year yield at one point was at its highest since last summer, since August, as Japanese yields hit their highest on record, as a maybe sell America trade starts to creep back in with a Danish pension selling their treasury exposures. Yes, only 100 million, but maybe it's a signal. But Matt, I mentioned this before. With this move, the NASDAQ will completely wipe out so far its year-to-date gains.
Yeah, I mean, it's been a pretty good investment, though, if you've held it over the last 3 years.
Yes.
I mean, it's only January 20th.
It does not feel like that.
So we're not that many trading days into the year. I will point out, though, if you're a bank charging more than 10% interest on your credit cards, after tomorrow, you will be in violation of the law, according to the president.
I was going to say that's an important caveat
of the United States. Get a look at some of the single stock stories this hour. Shares of ServiceNow fluctuating after a report that the software company signed a 3-year deal with OpenAI. It doesn't help today, down 1.3%.
And 3M, they delivered a profit outlook that fell short of Wall Street's expectations this year. They're looking to revamp their operation, shares getting crushed, down 5%.
Netflix amending its deal to buy Warner Brothers Discovery to an all-cash agreement now as the takeover battle with Paramount Skydance continues. We're going to give you more on that deal in just a few moments.
Still ahead on the show, we're going to head back to Davos for a conversation with Stripe co-founder John Collison and the CEO of Google, DeepMind. All those conversations coming up. This is Bloomberg.
Let's get now to high interest. Look what's making headlines around the world. Japan's finance minister is urging markets to stay calm after heavy bond selling drove long-term yields to decade highs. She said Japan's fiscal policy remains responsible, citing low debt issuance, rising tax revenue, and the smallest G7 budget deficit. Katayama stressed a planned tax cut would be funded without new bond issuance. And President Trump is escalating tensions with major U.S. allies ahead of Davos, blasting France's Emmanuel Macron online and threatening a 200% tariff on French wine after Macron declined to join Trump's proposed Board of Peace. Macron rallied against the proposed tariffs during a speech at the WEF in Davos.
Without collective governance, cooperation gives way to relentless competition. Competition from the United States of America through trade agreements that undermine our export interests, demand maximum concessions, and openly aim to weaken and subordinate Europe, combined with an endless accumulation of new tariffs that are fundamentally unacceptable, even more so when they are used as leverage against territorial sovereignty.
By the way, that was an indoor speech. So, nice shades.
Apparently he had a completely harmless eye condition, by the way, just for the record.
I get it. Okay. Treasury Secretary Scott Bessent urged allies to stay calm over President Trump's push to acquire Greenland, calling fears of European retaliation hysteria. Speaking in Davos, Bessent dismissed talks of Europe dumping U.S. treasuries as illogical, urged countries to honor trade deals, and reaffirmed that America's commitment to NATO remains unquestioned despite tensions. So no one is questioning our commitment to NATO.
What an interesting Davos this is shaping up to be. Away from Davos, one of the top stories we're following this morning, Netflix has reached an amended all-cash agreement to buy Warner Brothers studio and streaming business, prepares to announce earnings after the bell today. Joining us now is Geetha Raghunathan, Bloomberg Intelligence media analyst. Geetha, what difference does it make to have, as expected, Netflix now ponying up cash?
Yeah, the difference that it makes, Dani, is that it really kind of assuages investor concerns about the falling Netflix stock value. So remember, after they announced that deal to acquire Warner for over $83 billion, the value of their stock has been consistently falling. And their previous deal was basically a stock and a cash mix. And really what they're trying to do here is not just assuage investors, assuage WBD shareholders, but also kind of speed up a shareholder vote, which should now happen in April. So really kind of getting things here on the fast track for the deal.
We were just showing a one-year chart of Netflix shares, and the interesting thing is not the move from 12 months ago, but the move from the peak. Thank you, Joe. Look at that peak, right? 33% we've fallen on Netflix since the peak in the shares. Obviously, that makes the deal worth less if it includes shares. So does this assuage those shareholders who would have gotten this paper? Are they much happier to have cash and therefore go along with the deal?
I think they definitely are, happier to have more cash. There's more certainty. Having said that, though, I mean, at the end of the day, Netflix is all about fundamentals, and of course, there has been ever since the Warner Brothers deal was announced, Matt, there has kind of been this overhang on the stock because it really kind of muddles the narrative of what was otherwise a really clean story based on just its fundamentals and revenue and subscriber momentum. But, coming back to, of course, we're dealing with a couple of different things here. There is regulatory uncertainty from the deal, whether it actually gets approved. And then let's say, even if it's approved, there is all the time, the fear of integration risk, execution risk. So there are lots of different things that still have to kind of be ironed out. But I think at the end of the day, if you're really looking at this as a long-term play, Netflix fundamentals are pretty strong, and they're really hoping and banking on the fact that Warner is only going to add to their engagement metrics, to their pricing power.
Doesn't that make this earnings awkward, though, Geetha? If Netflix comes out and says, look how strong we are, look at what our live sports did, look at how popular K-pop Demon Hunters is in the season finale of Stranger Things, can they kind of talk about that strength and at the same time say, it's not a needless spend to buy Warner Brothers Discovery? Don't the two, at least in the mind of shareholders, present a conflict?
Yeah, I mean, that has kind of been, the question. The question has been, is Warner really, has the deal been because of slowing growth? And if they come out and they report these blockbuster numbers, as you were just suggesting, then that actually just says that, no, our growth is absolutely fine. This is just us playing the long game, prepping for the future, prepping for a future when there can be AI disruption, when you do have, the possibility of short-form video from the likes of TikTok and Reels and YouTube kind of take over. We still have a great strategy. We have some of the best content, in the world. And so I think that actually then adds to their whole argument. So, it's a kind of a wait and watch here.
I wonder, if Netflix were to lose out to Paramount Skydance, how much of a competitive threat would the Ellison vehicle then be? I mean, does Paramount Skydance really become relevant in the streaming wars if they get Warner Brothers Discovery?
They definitely become more relevant than they are right now. But I'm not sure it's necessarily enough because they're going to be dealing with a whole lot of other problems, Matt. So, we're looking at leverage that's something like close to about 7 times. You do have the whole problem of integrating the two companies, dealing with different management teams. And then again, you have, Paramount Skydance, which itself is a relatively new company. Remember, they just acquired Skydance. This is a completely brand new management team. So they do have a lot to prove. It definitely puts them in a stronger position, but I don't think it makes their lead necessarily insurmountable.
Geetha, great to get some time with you. Thanks so much for joining us. Geetha Ranganathan there of Bloomberg Intelligence. Now, in Davos, Switzerland, Stripe co-founder John Collison is speaking at Bloomberg House with Emily Chang. You can watch this conversation and a lot more if you have a Bloomberg terminal. You type Live Go to get all of our live coverage from the World Economic Forum. This is Bloomberg.
Site to find something, you might have done a search or something like that. Now there's a different discovery engine. You can have many more targeted conversational searches. You're looking for furniture and you're saying, okay, I want something that has kind of this feeling, and also, by the way, it should have these dimensions, fits within this space, and these are the manufacturers I like already. None of that is stuff you can do with existing keyword-based search, and you're going to see the conversions based on that. And so we think it could be quite a democratizing force because you could lead to discovery of lesser-known brands.
Now, some merchants are scared of getting sort of cut out of the equations. What kind of conversations are you having about that?
I think if your only value prop is aggregation and discovery within the current paradigms, you're going to have a lot of questions to answer. But if you sell based on the value of the brand and the product, and people have very strong brand affinity, that brand affinity is going to exist regardless of whether people go to your website or whether they buy it agentically or something like that. Or Amazon has invested for decades in their logistics and fulfillment footprint, and so they have phenomenal advantages here to be able to get the product to you very quickly for a low price. And so I think the discovery and aggregation advantages are going to change, but many businesses are differentiating based on different axes.
We've been talking a lot about sovereign AI and sort of the return of digital borders, or a desire, at least for digital borders. Is there such a thing?
Let's get a check on the stock market right now, looking at a drop of more than 1%. And you can see, I guess I'll start on the winning side because it's easier. here. Intel right now up more than 5%. So that's adding 1 1/3 points to the index. AMD also a gainer. You can see Micron, SanDisk, GE Vernova. So the usual suspects here are up along with ExxonMobil. On the downside, you've got Nvidia, and it's off by more than 3% this morning. That's why we see the drop in the S&P, right? The S&P currently is off about 82 points, and Nvidia makes up 16, 17 of those. Apple, Broadcom, Microsoft, Amazon, and Google. All of the hyperscalers, the whole AI trade, including Meta and Oracle and IBM, falling this morning. So that's a weight. If you go ahead and take a look at the industry groups, you'll see IT and comm services right at the bottom, or IT at the very bottom, and comm services right now down 1.25%, along with real estate and consumer discretion stocks there. On the upside, only energy with the rise in the oil price. That's why you see energy stocks and ExxonMobil up, but everything else is falling this morning as we worry about Greenland, clash with our allies in Europe, and Japanese bond yields. Coming up, we're going to look ahead to United Airlines earnings following a cautious profit forecast from Delta. This is Bloomberg Open Interest. United Airlines set to report earnings after the bell today. The results coming after competitor Delta provided a profit forecast that fell short of estimates, taking a more cautious view for 2026. Joining us now is Sid Phillip, Bloomberg's chief global aviation correspondent. And how do you expect today's results to go, and how did you see Delta's?
So analysts will be expecting to see what United forecast for the year, because United and Delta have both they've focused on premium customers as well as international travel. And so for analysts, they'll be looking to see what sort of signs domestic travel is showing in terms of premium demand, as well as international travel amid all the geopolitical tensions, and what sort of impact those will have on demand as the year goes by. So Delta was their shares went down after reporting earnings because investors were concerned that they were too cautious, and we will see what United puts out to the market and what their expectations are for the year.
It's a good point about international travel, and wouldn't that be really bad timing if this is where we see an area of pullback? Because hasn't United, Delta, all of them just invested pretty heavily in that exact segment?
It is, and they've Delta even now talks about how international is the growth opportunity for the future. And there is a lot of demand, especially from Americans going on holiday in Europe and other places. And so whether that trend will continue into 2026 amid all this tension, it's a good question to ask the airline CEOs.
The two things I always focus on, fuel and labor, obviously the biggest cost drivers for these airlines. We see fuel is cheap. How's labor look?
So labor is an interesting point for United, especially because they have they're still pending an agreement with their flight attendants union, which could add to their costs, especially at a time of this uncertainty. We're not quite sure when they will reach a deal, and so we will be looking to see any updates from the company about what the timeline for that deal and that negotiation is.
So the other thing that's happening, Sid, in your world is this spat, this argument, this brawl that keeps happening between Elon Musk and the Ryanair CEO Michael O'Leary. What is happening there? And Musk, posting, should I buy Ryanair? How much would it cost to buy you? Or is any of that, should we take it seriously? Might Musk try to buy a low-budget European airline?
It's anyone's guess at the moment, but it wouldn't be easy for Musk, especially as European rules don't allow control of an airline by a non-European entity. At the same time, Elon Musk is opinionated, and Michael O'Leary is also famously opinionated, and he's got an opinion about most things on aviation and otherwise. And so this is an interesting battle, especially at a time when Ryanair is doubling down on their low-cost business, focusing on the fact that low-cost. Michael O'Leary said that low-cost carriers, their customers don't expect free Wi-Fi on planes or Wi-Fi on planes. And so that's going to be an interesting situation, and it'll be interesting to see how that plays out.
He's wrong about that. I don't know about you, but when I'm flying on a plane these days, I expect them to have Wi-Fi.
On Ryanair, even
I'd be like, good enough to check
I can't
my
even.
emails.
I can't even recline my seat. I don't expect Wi-Fi.
I was going to say, Matt's not the customer for Ryanair. I mean, they talk about how their tickets are cheaper than pizzas, and so Ryanair is sort of famously known for charging for every single item, including.
By the way, I don't know if that's true. Right? I feel like, well, I mean, it's been a while since I've traveled Ryanair, but like maybe 3 years ago, it was not cheaper than a pizza.
True. I mean, they also tend to fly to airports where no other competition exists, and sometimes the airports are not quite where they are.
I'm looking at actually, I'm surprised that Ryanair stock has done better than Tesla stock over the past 5 years. I always look at a 5-year chart because the comp function defaults to 5 years. Ryanair total return 93% in the last 5 years, and Tesla only 50%. Now, okay, Ryanair is a 30 billion euro company, and obviously Tesla is a $1.5 trillion company, so it's a huge difference. But Michael O'Leary's done a pretty good job.
He has, and he's sort of in line for this major bonus package because he's managed to get the shares up 55% just last year. So for Ryanair, all this thing about buying Tesla, Elon Musk buying out Ryanair is great for the stock because it drives up the share price, and O'Leary is further on track to collect his big bonus.
Not as big as Elon Musk's bonus.
Literally no one's is as big as Elon Musk's bonus. I think that's fair. And any more opportunity to hear from Michael O'Leary, because he is objectively hilarious. He said, thank you so much for joining us. We'll keep an eye out for those United earnings later today. That's Sid Phillip from the Bloomberg Aviation team. A check on your markets this morning. We continue to sell off, down by more than 1% for all the major indices, but not as bad as we have been. Still down 1.1% for the NASDAQ. What's leading this? Is it a renewal of a Sell America trade with Trump's threats about Greenland growing, leaked texts, concerns in different speeches? Scott Bessent emphasizes that, yeah, this is important to us. Or is it the Japanese bond market with JGBs trading at a record high, leading Japanese investors to repatriate and 10-year yields higher by just about 5 basis points, Matt?
Yeah, I mean, we're still so close to record highs, right? 69.85, I think, is the record high.
Sounds
we're
right.
at 6,900.
But no one's hedging this thing, apparently. So the pain trade looks like it's down.
Even the blowout in yields is it's less than 5 basis points right now, right?
Yeah.
The VIX isn't even over 20.
But don't you think we're just like so primed by the lack of volatility that 1% or a 5 basis point move, we're like holding our chairs for life?
I tend to feel like, a lot of journalists are like waiting for this to happen and saying like, we're on the verge of the Sell America trade, but it is not happening.
No, it's not. 1% is not it. Or $100 million worth of treasury sales.
Yeah, exactly. Not yet. Until the Norwegian central bank or sovereign wealth fund starts to sell its equity stakes, I think we're going to be okay. Let's take a look at some of the single stock stories moving this hour. Intel is one that you may have noticed getting a big boost today, up 6.5%. Upgrades from HSBC as well as Seaport, the Hong Kong Shanghai Banking Corporation, saying agentic AI is driving upside to server CPU demand. From Intel? Okay.
Guess so. Gold and silver miners, those are rising in today's trade, along with precious metals as safe haven assets surged. Matt?
Some regional bank earnings out this morning. We've been telling you about them. KeyBank, the forecast apparently underwhelmed, but that doesn't matter anymore. Investors are bidding the stock up more than 1%. The same is true with U.S. Bancorp. Their outlook topped estimates. Fifth Third came in line with results, but all of these shares have been moving kind of in lockstep. So they were all down earlier, now they're all up.
Still ahead, we're going to have more from Davos. That includes conversations with the CEO of Google DeepMind. We head back to Bloomberg House. That's after this break. You're watching Bloomberg Open Interest.
Let's get back to Davos, Switzerland. The CEO of Google DeepMind is speaking at Bloomberg House with Emily Chang. Let's listen in.
Between us, we've invented most of the breakthroughs that the modern AI industry relies on now. Obviously, transformers most famously, but AlphaGo, deep reinforcement learning, these things. And we have these incredible product surfaces, billions of user services that are natural fits for AI, actually, from search to email to Chrome. And but it's just getting all of that together and organized in the right way. And I think we've done that in the last couple of years. And there's still a lot more work to do, but I think we're starting to see the fruits of that.
If you think you have an advantage, how big do you think your advantage is? How long does it last?
Well, I think everything starts with research, in my opinion, and the models, especially being state of the art on all the different benchmarks, and that's what we focused on first when we put Google and DeepMind together. And I think with the Gemini series, we're very happy with how that's going. There's a lot more work to do there, but I think we're the only organization that has the full stack. From the TPUs and the hardware, the data centers, the cloud business, the frontier lab, and all of these amazing products that can, kind of natural fits for AI. So really, structurally, from first principles, we should be doing very well. And I think there's actually a lot more headroom to come from here.
I wonder what a day in the life of a frontier model leading AI CEO is like. Like, I've read that you do most of your thinking between 1 and 4 a.m.
Yes, that's right.
Is it ever not a code red inside? Do you ever feel comfortable?
No, you never feel comfortable. I mean, we try, code reds are for very special circumstances, but it's always, for the last, I would say, 3-4 years, it's been unbelievably intense. And, 100-hour weeks, 50 weeks a year, and that's the norm. And I think that's what you have to do at the forefront of this unbelievably fast-moving technology. It's ferociously competitive out there, maybe the most intense competition there's ever been in technology. And the stakes are incredibly high, AGI and all of that can mean. So commercially, scientifically, and then if you add all the excitement of what we're doing and, using it as my passion, as is exploring scientific, problems with AI, accelerating scientific discovery itself. This is what I've always dreamed about, and I've worked my whole life on AI towards this moment. So it's sort of hard to sleep because there's so much work to do, but also there's so much exciting things to look into and to push forward.
I know you're very focused on AI driving scientific progress, discovering new materials even. We've seen now Gemini being integrated into humanoid robots. Is the AlphaFold moment for the physical world and AI here? What is that, and what does that look like?
Yeah, I spent a lot of the last year actually looking very carefully into robotics. I do think we're on the cusp of a kind of breakthrough moment in physical intelligence. I still think we're about 18 months, 2 years away from we need to do more research, but I think the foundation models like Gemini show the way forward. From the beginning, we made Gemini multimodal, so it could understand the physical world for multiple reasons. One was so we could build a universal assistant, maybe that exists on your glasses or your phone that understands the world around you. But of course, a second use of that would be for robotics.
So what does that moment for the physical world look like?
I think it's having robots, reliably do useful tasks out in the world. And I think there's a few things holding that back still. Part of it is the algorithms are still not quite there. They need a little bit more robustness. They have to work with less data than you get for the LLMs or the models that work on just digital realm. You can sort of create synthetic data. It's a lot harder to make that kind of data. And there's still sort of some problems in the hardware that are not solved, specifically things like the arm and the hand. Actually, when you look into robotics very carefully, you get a newfound appreciation, at least I did, for the human hand and how exquisite evolution has designed that. It's incredible. And it's very hard to match the reliability, the strength, and the dexterity that the human hand has. So there's still quite a lot, in my opinion, pieces that put together, but there's very exciting things. We just announced a new deep collaboration with Boston Dynamics. They've got some very exciting robots in Hyundai and actually applying it to automotive manufacturing. And we'll see over the next year how that goes in sort of prototype form. And then maybe in a year or two, we'll have some really impressive demonstrations that we can scale up.
A year ago, DeepSeek seemed cataclysmic for the West. Now, a year later, it's quiet. China seems to have been quieter.
Yes.
Has your opinion on competition from China changed?
Not really. I didn't think it was cataclysmic in the first place. I think it was a massive overreaction. In the West, it was impressive. And I think it shows that the Chinese are very capable, the leading companies. I think companies like ByteDance actually, I would say, are the most capable. And they're maybe only 6 months behind, not 1 or 2 years behind the frontier. So I think that's what DeepSeek showed. Some of the claims were over-exaggerated about, the amount of compute they used and being so minimal and so on, because they relied on some Western models and also fine-tuning on the outputs of some of the leading Western models. So it wasn't sort of de novo. And the other thing I think so far is not, yet to be seen is, can China actually, the Chinese companies innovate beyond the frontier themselves? So they're gaining, they're very good at kind of catching up to where the frontier is and increasingly capable at that. But I think they've yet to show they can innovate beyond the frontier.
You helped define AGI. You have said we have a 50% chance of getting there by 2030. Is that still your timeline?
It is.
And is AGI still a useful target for you?
I think so. I think it's that is still my timeline. And it's a little bit longer than some others some of my peers that you'll hear. But my bar is quite high. It's the ability to, a system that exhibits all the cognitive capabilities humans have. And I think we're still clearly quite far from that. That means, in things like scientific creativity, not just solving a conjecture or solving a problem in science, but actually coming up with the hypothesis or the problem in the first place. And as any scientist knows, finding the right question is actually often way harder than finding the answer. So it's not clear that these systems have that capability yet. In fact, they definitely don't right now. I think they will eventually, but it's not clear what's needed still. And there's things like continual learning, online learning, going beyond what they've been sort of trained for, and then they're static out in the world. They need to learn on the fly. So there's quite a few, in my view, missing capabilities that are quite critical to what I would regard as an AGI system.
Google's a major investor in Anthropic. Dario was here earlier today. Yes. Do you agree or disagree with his prediction that AI will wipe away 50% of entry-level white-collar jobs in 5 years?
I think that's also my timelines and my view on that would be a lot longer. I mean, I think we're starting to see maybe the beginnings of that this year in terms of maybe entry-level jobs or internships, those types of things. But I think we would have to solve a lot more of this consistency that AI doesn't have right now. I call it jagged intelligences. We're very good at certain things, and it's very poor, the current systems, at other things. And if you want to offload or delegate an entire task to, say, an agent, rather than having what we have today, which are more like assisted programs, you're going to need a lot more consistency across the board. It's no good for it to be good at 95% of that task. You need it to be good at the whole task for you to be able to actually just sort of fire and forget on it. So I think there's still quite a lot more to be done before we'll see that kind of disruption.
But that kind of disruption will happen.
I think eventually, sure. I mean, in the limit with AGI, if you have systems like that, I think that changes the whole economy, actually. It's way beyond the question of jobs. I think potentially if we build it right, we're in a post-scarcity world where we've solved some of the kind of fundamental root nodes of the world, like energy sources, new, clean, renewable, basically free energy sources. If we solve fusion, something like that, with the help of AI, new materials, I think we'll be, 5-10 years past AGI, we'll be in a radical abundant world. And so what does that mean with, to the economy and how society works, actually?
Before we get to a post-scarcity world, though, if we get there, there is so much anxiety about what happens in between. I'm a mom. I know you have kids. What scares you most for them? What do you talk to them about? What do you tell them that's coming? I mean, I've just heard so many things. Oh my gosh, for college graduates are going to have such a hard time.
Well, I don't know about that. Look, I think it's going to be an age of disruption, just like the Industrial Revolution was. Maybe 10x of that, which is kind of unbelievable to think about, and 10 times faster. So I usually describe it, it's going to be 10 times bigger and 10 times faster than the Industrial Revolution.
To your
so
kids.
100x.
Okay.
So 100x of it. No, I say this to everyone, but I think that comes with it huge opportunities. And I also am just a big believer in human ingenuity. We're extremely adaptable because our minds are so general. The human mind is very general. We've adapted. Look at the modern world around us. Our hunter-gatherer minds have managed to build modern civilization. So I think we'll adapt again. I think it's a little bit unprecedented because of the speed of it. Usually it takes 1 generation or 2 generations for a transformation like this to happen, and the magnitude of the transformative power of this technology. But I think the kids today, I'd be encouraging them to get incredibly proficient with these new tools and native with them. And they're almost equivalent of giving them superpowers, in the creative arts. That you could probably do the job of, what would have taken 10 people in one. And I think that means, if you're entrepreneurial, if you're creative with game design, films, projects, you can probably get a lot more done and break into those industries a lot more easily than you could in the past as, a new upcoming talent.
Some folks have advocated for a pause to give regulation time to catch up, to give society time to sort of adjust to some of these changes. In a perfect world, if you knew that every other company would pause, if every country would pause, would you advocate for that?
I think so. I mean, I've been on record saying what I'd like to see happen. It was always my dream of the kind of the roadmap, at least I had when I started out DeepMind 15 years ago and started working on AI, 25 years ago now, was that as we got close to this moment, this threshold moment of AGI arriving, we would maybe collaborate in a scientific way. I sometimes talk about setting up an international CERN equivalent for AI, where all the best minds in the world would collaborate together and do the final steps in a very rigorous scientific way, involving all of society, maybe philosophers and social scientists and economists, as well as technologists, to kind of figure out what we want from this technology and how to utilize it in a way that benefits all of humanity. And I think that's what's at stake.
A very existential conversation down at Bloomberg House. That's the CEO of Google, DeepMind, speaking with Bloomberg's Emily Chang, and you can continue to watch that conversation and more at LiveGo on your terminal. Coming up, we're going to set you up for the trading week, which includes President Trump's speech in Davos tomorrow, the market-moving event of this week. We'll have that coming up next. This is Bloomberg.
We want to give you a look at what's ahead for the markets this week. Netflix and United Airlines reporting results, as we've been telling you, after the closing bell today. Tomorrow, President Trump is set to speak in Davos. Plus, we're on watch for a potential Supreme Court ruling on tariffs. And as of tomorrow, it will no longer be legal for banks to charge more than 10% interest on credit card balances. Thursday, we get PCE, jobless claims, and earnings from Intel. And that stock has been one to watch today. Finally, on Friday, a BOJ rate decision. And, it's pretty incredible how much yields have gapped higher, Dani, on JGBs. One of the two things that's obviously we've focused on today, but obviously for us, Greenland is more interesting, I guess, because it's the U.S. kind of turning on its own NATO allies.
Sure. On
the other hand, for financial markets, the JGB yield's equally important.
And maybe even more important, because we have learned that with every Trump threat of tariffs, that you would get hurt if you sold on that. You would miss on eventual gains and rebounds. But with the 30-year yield, you are seeing U.S. bond markets move, and it's impacting stocks. Stocks are still up, still off about 1% so far this morning, both for the S&P, I think even more for the NASDAQ.
All right, coming up tomorrow, Lori Calvasina joins us of RBC Capital Markets. Always a fascinating conversation. She'll be with Nathan Hager on Bloomberg Radio, I imagine, first. David Lefkowitz joins us from UBS, and our Davos coverage continues. We'll bring you President Trump's special address at 8:30 a.m. New York time. This is Bloomberg.